In this video, we will talk about macroeconomics. So what is macroeconomics? Macroeconomics is a branch of economics which analyzes the entire economy. So what are we dealing with? So it deals with terms like total employment, national income, national output, total investment, inflation, trade cycles, business fluctuations, etc. In short, macroeconomics is a study of aggregates. So there are few definitions of macroeconomics. The first one was given by J.L. Hansen. According to him, macroeconomics is that branch of economics which considers the relationship between large aggregates such as the volume of employment, total amount of savings, investments, national income, etc. And according to Professor Carl Shapiro, macroeconomics deals with the functioning of the whole economy as a whole. Thank you. Now let's understand the scope of macroeconomics. So there are four scopes of macroeconomics. First is theory of income and employment. Second is theory of general price level and inflation. Third is theory of economic growth and development. And fourth is macro theory of distribution. Now let's look at them one by one. So the first is theory of income and employment. So macroeconomic analysis explains which factors determine the level of national income and employment and what causes fluctuations in these levels. To understand it, we have to understand how the level of employment is determined. Then we have to study the consumption function and investment function. Theory of business cycles is also part of this. The next one the next one is theory of general price level and inflation. So macroeconomic studies the general price levels and it can also explain how inflation affects the general price level. It also tells us how inflation increases or decreases in the economy. The third one is theory of growth and development. Macroeconomics explains the causes of underdevelopment and poverty. It can also suggest various strategies for accelerating growth and development. The fourth is macro theory of distribution. So macro theory of distribution deals with the relative shares of rent, wages, interest and profit in the total national income. So the first important thing to understand about macroeconomics is that it is study of aggregates. So it is concerned with national income, national output, national employment, everything at national level. Price levels, inflations, business cycles, everything at national level. The other thing we have to understand is income theory. Macroeconomic studies the concept of national income, its different elements, methods of measurement, and social accounting. It deals with the aggregate demand and aggregate supply. It explains the causes of fluctuations in national income that leads to business cycles, that is inflation and deflation. Macroeconomics also studies the general equilibrium and the interdependence of large aggregates. So what does it mean? So let's say a country's GDP is growing year on year. So macroeconomics can tell us what will the effect of these things on the employment, inflation, national income and business cycles. The next thing we have to study is lumping method. So what does lumping method mean? Lumping method is a study of the whole economy rather than the parts. So in microeconomics, we study small parts in a large economy. In macroeconomics, we study the entire economy.